It's time for the Personal Finance Corner, and today we're going to discuss a new fund offer that's just been launched.
That's true, Sandeep. It's only open for 24 hours, so let's quickly get a view from Dhirendra Kumar of whether or not it makes sense for us to invest in it. This is an NFO. Given all of the debt funds in the market, Dhirendra, right now, the DSP, BlackRock Banking and PSU Debt Fund, open for 24 hours, will end by the end of the day. The scheme will invest in a portfolio of debt and money market securities issued exclusively by banks and public sector entities. Tell us what the advantages of such a specific scheme would be.
One is that, if a fund is going to buy only the fixed income, securities of public sector companies and banks, which means it's not a compromise on safety. And more so, the dominance of public sector and in the banking industry, the dominance of public sector banks. So that makes it, a quasi-sovereign guaranteed instrument or issuance. That is one. So it is very high on safety. At the same time, they are not very long-tenor funds. So when a fund is abstaining or keeping away from government security, it is insulating. Basically, it is unlikely to get into very long-term bond. Long maturity will be avoided. So it will be less volatile, and it will be reasonable. It will be in reasonable credit quality. So this fund should be able to deliver marginally superior return than intermediate term or a long-term income fund.
Well, Dhirendra, in that case, should we as retail investors be considering a fund like this, or would you advise us to stay away from it?
No, these NFOs are avoidable. At the same time, a fixed income investor should try and look at something which is very low maintenance. This is for the nuanced institutional investor who want a marginally superior return. They also don't want to compromise on the credit profile. So it will have its market, but I don't think it is meant for all kind of investors. Most investors need are better fulfilled by matching their time frame with the right kind of fund. So today, if you are a long-term fixed income investor, you don't want to take chances with your money, and you are willing to compromise on the liquidity. You are unlikely to need that money for the term that you are going to, you have a tentative time frame in your mind, and you are unlikely to need that money before that. Think of an FMP. For shorter time maturities, time frame, think of liquid fund or ultra short-term bond fund or short-term bond fund. I think these open-end bond funds are avoidable, and particularly the new dimension that has been added is that the fixed income has become so much more volatile in the last 1.5 months, and that is unlikely to come down because FII's investments in fixed income, that is causing some kind a far higher degree of volatility, which an individual investor might find very unnerving.